Hello and welcome to the Owner Finance Academy, where we help Canadians build wealth by buying U.S. real estate and selling with owner financing. Before we begin, a quick reminder that everything shared on this channel is for educational purposes only. Every situation is different, so always consult a qualified legal, tax, or accounting professional before making your final investment decisions. In this lesson, we're going to look at why we teach slow flipping rather than traditional house flipping, particularly for Canadians who want to invest in US real estate and to do so remotely. By the end of this video, you'll understand how the two strategies compare in terms of the returns, the work involved, the risks you take on, and their ability to produce long-term cash flow. Traditional house flipping follows a familiar script. You buy a house at a discount, you renovate it, and you sell it for more than your total investment. The objective is generally to create a lump sum profit from the difference between your total cost and the eventual selling price. Now, that can be a very successful real estate strategy, and many have been doing it for years, from Canada and the US alike. It is designed to produce a different kind of outcome from the outcome we are seeking to achieve with the slow flip strategy. In a slow flip model, we buy distressed residential properties as well at a low purchase price, but then we sell them in their current condition using owner financing. There is no renovation or construction program intended to increase the property's resale value. Instead, the economics of the investment come primarily from buying at the right price and structuring the financing correctly. That difference is particularly important for Canadians investing in the United States. We're trying to remove the renovation operation. Traditional flipping requires more than just finding an inexpensive property. Mm-mm. Once you buy the house, you have to manage the process of improving it. And believe me, it is a process. It can mean finding contractors, obtaining and comparing quotes, purchasing materials, monitoring the work, dealing with delays and cost overruns, and verifying that the work has been completed properly. When you're investing from Canada, much of that work has to be done and managed remotely. Slow flipping deliberately removes that part of the investment process. Mhm. We're still buying distressed properties, don't get me wrong, but we are looking for a very specific type of distressed property. In this model, the house can be dated. It can be unattractive. It can need cosmetic work, but it must meet the physical criteria we establish before buying. For example, we look for basic livability functions like a working mechanical system, usable kitchen, usable bathroom, no major structural problems, or no active roof leaks. The objective is to buy a property that can reasonably be sold in substantially the same condition as when you purchased it. Therefore, you're buying as is and selling as is. This is important because eliminating the renovation will do two important things. It will reduce the amount of work that has to be coordinated remotely, and it also removes a major source of uncertainty. A renovation budget is still an estimate until the work is completed. Additional problems can be discovered, costs can increase, contractors can be delayed, the project can take much longer than you expected. Slow flipping does not eliminate real estate risk entirely, but it does allow for you to avoid taking on much of that particular category of execution risk. Instead of managing a renovation after we buy, the slow flip approach puts significant emphasis on making the correct decision before you buy. We use sales comparables to estimate what the property is worth in its current condition. We then use rental comparables to determine what someone can reasonably afford to pay you each month as a comparable to renting that same kind of property. We establish the maximum purchase price that the completed deal can support. And then we apply a defined physical property profile to determine whether the house qualifies. A property has to pass both the financial and the physical filters. If it does not, we discard the property altogether and move on to the next one on our lead list till we find the gem. This is particularly useful when investing remotely because the objective is to make the investment more predictable before you spend any of your hard earned money. We're not buying a problem and then trying to create our margin by fixing the problem. The absence of renovation is useful, but that's not the main reason we teach this strategy. Mm-mm. The larger difference is what the investment is designed to produce. With the traditional flip, the objective is generally to generate a lump sum profit when the house is sold. You complete the transaction, receive the proceeds, and move on to another property if you want to generate another big profit. Slow flipping uses the sale differently. We sell the property to an occupant using long term seller financing. Depending on the state, the agreement may be called something like a contract for deed, an agreement for deed, or a land contract. The occupant provides a down payment and then makes monthly payments over a long amortization period. In the United States, it is commonly 30 years versus the 25 years we're used to in Canada. That means we're not simply using the property to create a resale profit. We're using the property to create a long term stream of payments. Now, exactly how does the cash flow develop? The course that we teach here at the Owner Finance Academy uses a simple example to demonstrate how all this works. So let's use the same kind of example. Suppose we purchase a property for $30,000 US using private financing. So we are borrowing the money at something like 13% with a 5-year amortization. The monthly payment from you to your lender is about $683 per month. We then right away sell the property to an occupant for $89,000. We're using a 30-year amortization at 10.5%. So their payment to you is $875 per month. During the first 5 years, most of that 875 is absorbed by the 683 that you owe back to your lender. And the rest, you will pay your property taxes and insurance. So this is not a strategy that is built around producing immediate cash flow. The important point comes when the acquisition loan that you use to pay is repaid. So after your first 5 years, the $683 payment ends, but your occupant's payment of $875 coming to you, well, that continues. And that is the fundamental financial trade off that we are making. Traditional flipping is designed to create a larger financial event sooner, but slow flipping is designed to create a smaller financial stream that can continue for many, many years. The work also changes after the sale. Once we sell the property to the occupant, we do not operate the investment as a traditional rental property. The occupant is a buyer in progress under the seller financing agreement. So day to day occupancy and property responsibilities shift in accordance with that agreement. Our role increasingly becomes just administration of the financial relationship, really not a manager of the property. Now, don't get me wrong, that still requires work. Payments need to be collected and tracked, taxes and insurance need to be managed, records need to be maintained, communication needs to be documented. And if there's a payment that is late or an occupant defaults, the procedures in the agreement and the applicable laws do need to be followed. But much of this work is administrative in nature and can be supported using systems. Payment collection can be standardized. Bookkeeping can be organized by property. Communication can be centralized. You can send your notices and records using email. And as the portfolio grows, those great principles and systems that you've put in place with your first couple of properties can easily scale. For a Canadian investor operating across border, that can be considerably easier than repeatedly managing a physical renovation project in another country. Now, none of this means that slow flipping is no risk or completely passive. Look, an occupant can suddenly stop paying. A property can suffer some natural disaster and damage, which requires you to deal with the insurance. Insurance and property taxes can increase, which means you need to have enough buffer in your monthly payment to absorb. A house can remain vacant longer than expected until you can find an occupant to replace someone who's left unexpectedly. And when you're using private money, the investor that you've borrowed from, well, they need to continue to get paid regardless of whether or not your occupant is paying you. The distinction is therefore not that traditional flipping has risk and slow flipping has none. Nah. The distinction is really in the type of risk that you choose to take on. With the traditional flip, you're taking on execution risk, and with the slow flipping, you are taking on more administrative risk. Traditional flipping introduces the issue of renovation and project management. Slow flipping removes that particular aspect, but now you're dealing with the paper, the long term financing, the payment, and the performance of your occupant. For the strategy we teach, we manage those risks through disciplined acquisition, conservative financing, properly screening the property, and also properly screening your occupant. Now, when we put all these pieces together, the reason we teach slow flipping for Canadians becomes, well, pretty clear. We want to be able to invest in the United States without building a remote renovation company. We want properties that can be purchased and resold essentially as is. We want clear financial and physical criteria that allow us to reject an unsuitable property without having to do a deep dive inspection. And most importantly, we want the investment to create long term monthly payments rather than requiring us to continually complete a significant project in order to generate a lump sum. Now, don't get me wrong, we still need a team, a US team. The slow flip strategy relies on people such as a realtor or wholesaler, a title company, an insurance professional, an accountant, legal counsel, and most importantly, your boots on the ground. They are the people who will do some of the in person work, like changing a lockbox or delivering a notice in person, or maybe at times just checking on the property to ensure that everything is still in order. This allows you, the Canadian investor, to remain primarily responsible for the administrative, financial decisions, and transactions that you can do easily remotely using systems. So, the key takeaways for you today are when we compare traditional house flipping with slow flipping, we should not ask which strategy is universally better. They are both viable approaches to real estate investing. They're designed to accomplish different things. Traditional flipping can make sense when your objective is short term profit and you have capital, you have expertise, you have local infrastructure, and you have the risk tolerance to acquire and renovate and resell properties consistently in order to generate worthwhile returns. The slow flip strategy we teach is designed around a different set of objectives. We buy carefully, we avoid renovations as much as possible, we sell using owner financing, and we receive ongoing payments from the occupant. And that payment is used to repay our own loan that we use to borrow the property. And it's also the source of the ongoing income. Once the acquisition debt is done, really, we profit. And that means the first 5 years of repayment are a period of true investment. For Canadians looking to invest remotely in the US, with an emphasis on long term cash flow and a more manageable operational model that mitigates risk being at a distance, we found that this is a strategy worth considering. Well, we hope you found this lesson helpful. If you'd like to learn the complete Owner Finance Academy system for Canadians investing remotely in the US, you'll find a link to the full course in the description below. If you're not quite ready for the full course, but you'd like to have a tool that can help you evaluate if a property you're looking at is a right fit for the strategy, go ahead and download the Slow Flip Viability Diagnostic. And if you would like to learn in a group, Well, you can join the next free cohort where you'll be part of a group of Canadians learning the slow flip investment strategy, and you would be getting help as well from me to help you make your first purchase. You'll find the link to apply to that cohort also in the description. Thank you for watching, and we'll see you in the next lesson.